Started. Welcome everybody. All right, and go Royals, right? Woo! All right, I see some royal blue in the audience, so that's good. Okay, thank you guys for being here today. We're going to obviously be talking about the employee benefits for 2015. We're going to talk, first I'm going to talk about dates, some important dates that we have starting today and coming up in the next couple of months. And then we're going to talk about what has not changed as far as our benefits. Then we're going to talk about what has changed as far as our benefits. And then we're going to finish up talking about health insurance because that is the biggest changes of all. So starting with dates. The first date to keep in mind is today. Today is the first day to sign up for the wellness program. Okay, so you guys all have a handout from CHC that has the instructions for going on to CHC's website and signing up for the wellness program. You can complete the health risk assessment. You can sign up for a biometric screening. And the biometric screenings are scheduled for November 4th, 6th, 14th, and 15th. Okay, the 15th of November is a Saturday, so if anybody needs a Saturday screening, or if anybody's spouse needs a Saturday screening, you might want to keep that day in mind. Also on the biometric screenings, remember that is a blood draw, and so it is a fasting test. So you will need to make sure to remember to fast for 12 hours before that test. Another really important date coming up, November 1. What's November 1? Oh, come on. It's when our pay raises go into effect. Woohoo! All right. So everybody, automatic, across the board, 2% pay increase for everybody on November 1st. One thing to keep in mind, November 1 is in the middle of a pay period. So this year, your first paycheck in November, part of that will be at your old rate and part of that will be at your new rate, okay? So it'll be your second check in November where you will see the entire increase in a full paycheck, okay? Let's see, November 19th is the next date to keep in mind, and that's our flu shots. Flu shots will be held here in City Hall, across the hall, in the large conference room from 8 to 10 a.m. that day. Your spouse, if your spouse is on our health insurance, is also welcome to come. Just please be sure to bring your health insurance card. There's no cost to you to come in and have that done. November 25th is the first day of open enrollment. Our online open enrollment program will go live that day. We will send out a link closer to that time, probably a day or two ahead of time, to explain how to sign up to how that program will work. One of the things that I need you guys to keep in mind is your dependents updated. Has everybody gone online into the employee e-services and updated your dependents? All right, Sunny has, all right. One of the things to keep in mind is that your spouse is considered a dependent for this, okay? So the way the system works is that our online program is actually being developed by our GIS guys internally, in-house, okay? They will be downloading the information out of our payroll system just before the system goes online, and they'll be pulling your dependents out of that system then, okay? So if you don't update your dependents now, when you go to do your open enrollment, they won't be in the system, the online open enrollment system, okay? Which means then you won't have them available to mark to sign up for the benefits. So it's really, really important that everybody goes out into that system and updates their dependents, okay? Make sure you add your spouse and all children so that you have that flexibility when you then go to do your open enrollment. Got it? Anybody has any questions about it, please feel free to give me a call about it, okay? And then December 4th is our health and benefits fair. It'll be next door at the police department training classroom. And it'll be 8 to 4 that day. All of our vendors will be there. So if you have any questions about any of our insurance benefits, they will be there to answer questions that you have. And we will also have computers set up for anybody that wants some assistance in going through that online program and getting enrolled in the benefits. We will be there to help you get through that process, okay? So that is also the last day of open enrollment. So you will need to make sure by the close of day, December 4th, that you have gone online and signed up for your benefits. And then January 1 is when all of the benefits will go into effect. Okay? All right, so let's talk about what has not changed, because that's really quick and fast. What has not changed is our dependent and supplemental life. Those two, there are no changes. Rates are the same, plans are the same. Critical illness with cancer, if you have that plan, there are no changes to that plan at all. Accident insurance, same thing, no changes. Long-term disability and group life, from your standpoint, there are no changes. Okay, the plans are identical, the benefits are identical, the rates actually are going up on those, but that is one of the benefits that the city picks up the entire cost of that benefit, and so the city is picking up the entire cost of the increase. Okay, so you, from your standpoint, no changes. So then what is changing? Dental insurance. On dental insurance, the plan is identical. Nothing as far as the benefits, the network, anything like that is changing, but the premiums are going up a little bit. So the city will continue to pick up the full cost of the employee-only dental coverage, but if you cover any of your dependents, your cost will go up a little bit there, okay? Vision, identical. Vision, the plan is the same, the benefits are the same, the network is the same, it's the Davis network. The cost, the premiums, each month are going up a little bit, so if you have one of those plans, you'll see a little bit of an increase in that, okay? The wellness program. The wellness program in and of itself really is not changing. As I mentioned, you can go online starting today, do your health risk assessment, sign up for your biometric screening. If you do both of those, get your biometric screening done, then you will automatically qualify for the insurance premium incentive for January through June of 2015, okay? Remember, if your spouse is on your insurance and you want to get that incentive, both you and your spouse must participate. So that part of it hasn't changed any. And then you would need to earn 325 points. If your spouse is participating, they also would need to earn 325 points by May 28th in order to get the premium incentive for July through December of 2015. Okay, that basic structure of the plan, none of that's changed. However, we have done a few program updates as far as your ability to get points, okay? And those are on this page that we passed out. One of the things we added is the flu shot. If you do get your flu shot, that's 25 points. And whether you get that here or if you want to get that through your doctor's office, that's fine too. It'd still be eligible for 25 points. We also are using the electronic activity trackers. So any of you who use one of those, something like a Fitbit, something along those lines, you can turn in your reports from that and get points for it. One thing to keep in mind is if you use an electronic tracking device, you cannot also turn in points for like gym visits and stuff like that. Okay, so you can't double dip. You got to do either one or the other. Also, if you use the Lose It app, that's an app where you can actually go in and you can put all of the food that you eat every day into that app, and it tracks how many calories you've eaten each day and that type of thing. If you do that program for 3 months and submit the report that shows that for 3 months, you can get 75 points for the weight management program. Okay, so that's another great benefit. 5Ks, we're allowing 2 5Ks now. Originally it was 1 for 50 points. You can do up to 2 now to get a total of 100 points. A triathlon, we've added that in, that's 75 points. And then another thing that we're doing is we're adding an incentive program just for the points. One, we want to encourage people to get their points early instead of waiting until May 27th to try to get all of their points. And 2, we're trying to encourage people to continue to be active even after they've gotten their points. So starting in January, for everybody who's already received their 325 points, their name will go into a drawing. And we will draw out, we have different prizes, and it'll be mystery prizes each month. There'll be things like gift certificates, all the way up to Fitbits. We have some Fitbits. We're going to be giving Fitbits away this year, guys. So also, if for every 100 points over 325 that you get, that's an extra time your name gets thrown into the hat. Okay, so if you get 525 points, you would get your name thrown in 3 times for each drawing, and each month, and we'll do it each month starting in January. Okay? So keep turning in those points and get your name in there. Any questions about the wellness program at all? All right. Yeah, technically it's November 1st, but maybe if you bring that in, we might be able to, because it's awfully close. It's awfully close. Okay, so let's talk about unreimbursed medical and childcare. How many of you guys have participated in unreimbursed medical or childcare in the past? A lot of you. Okay, does anybody have any questions? Does everybody understand how unreimbursed medical and childcare works? Is there anybody that wants me to kind of give a little brief overview of how those plans work or their purpose? No? Okay. Well then, in that case, the unreimbursed medical and the childcare, the way they work, the amounts that you do, there's the federal guidelines are still the maximum you can put in for unreimbursed medical is $2,500 a year, and for childcare is $5,000 per year. None of that's changing, but we are changing our third-party administrator who is actually administering that program. We've been going through ASI out of Columbia, really for a long time now, but we are switching it to Guardian. Okay, so their program works pretty much the same. The one nice thing, though, that we're going to be adding is debit cards for the unreimbursed medical. Okay, so if you participate in the unreimbursed medical, money will be credited onto your debit card. You go to the doctor's office and you have to pay a $25 copay or a $30 copay. You just give them the debit card. They run it off the debit card, and you don't have to submit receipts or turn anything else to get it taken care of. So you don't have to pay in advance and then get reimbursed. So that's really cool. That'll work nice. The child care does not use the debit card, so that would work the same way it's been working. Okay? The debit card is a debit card that would be in your name, and so if you go to the doctor's office, you can use that debit card to pay for your copay, and it'll take the money off of that debit card, and it'll come out of the account that you have for your unreimbursed medical. Mm-hmm. Mm-hmm.
Yeah.
Right.
Okay, that's, I missed that.
Yeah. So the debit card, Lisa, how'd you say it? The debit card, it instead of you getting reimbursed, it goes on the debit card and comes out of the account. Whatever you use on January, whatever you put into your account for the year goes onto the debit card, and then it gets paid out. Okay?
At the doctor's office. I mean, what if you want to wait till the end of the year?
The question is, what if you don't want to use it at the doctor's office? You want to wait till the end of the year? That's absolutely fine. You don't have to use it at the doctor's office. You can go ahead and you can pay for your copay at the doctor's office and wait until the end of the year and submit receipts, or maybe you have, maybe you're getting wisdom teeth pulled or something, I don't know, at the end of the year, and you want to put it all onto that, you can do that too. Yes, you can still submit claim forms if you prefer to. Any other questions? Did you have a question? Did we? Yeah, or you can even have the doctor's office run it on the debit card each month. Mm-hmm. Yep. Lisa?
So I'm not going to be able to do what I do now, where I use my unreimbursed medical as like a savings account for myself. I can't submit my reimbursement. It goes to my direct deposit, and I can use that for Christmas at the end of the year. Do you know what I mean? I
You
pay
can
for,
do that if you prefer. If you
okay,
don't,
so how do I use my debit card?
just don't use your debit card. Just pay for everything as you go during the year. That's kind of like Kay was talking about. Just pay for everything as you go during the year, and at the end of the year, submit all your receipts, and they'll give you all that money back at the end of the
And
year.
how will I get that money back?
You'll have to submit a claim form with
Okay.
the receipts.
And will I get a check?
You can either get a check, or you can have it direct deposit
Okay.
into your account, however you set it up with Guardian.
Okay.
Trish?
What are the restrictions on the debit card then? How is the debit card going to know that you're truly at a doctor's office that's allowable? Because some things I know before, like they weren't allowing, certain over-the-counter type things.
Dulce, maybe you have the best answer for it. This is Dulce Wood, and she is with Guardian.
Hi, everybody. Let's say you go to the store and you buy true medication that was prescribed, and you also want a lipstick. So when you go and pay, you swipe your card, and the receipt is going to say, yes, this is a medical expense, and this one is not. So the money to cover the prescription will come from the card, and the other one is not going to be paid. You have to pay right there.
And that's not at all retail places. Be very careful. Walmart, I know, does it. Walgreens, I know, does it. But if you go to some mom and pop shop and you pick up, prescriptions or something like that, and you pick up the lipstick, be careful, because that debit card, your FSA card, might run through and take that lipstick too. Okay, so you have to watch things. Some of the bigger chains, yes, the way they have their system set up will catch all of that. Some of those smaller chains or mom and pop shops will not catch that. Okay.
But you're definitely going to want to watch that, because you could get penalized for doing that.
Over here.
So then you're saying that the transaction will go through as opposed to being rejected? So I'm not sure how that works from the standpoint that the money is a pre-tax money, and you're now being allowed to purchase something with pre-tax money that is not part of the stipulated items you're allowed for. Why would it not stop the transaction as opposed to letting it go through?
I think it's because some companies, some of the mom and pop shops, don't have the technology to do that. So it is your money, it is your account, and you are the one that would be held responsible. So that is why you need to watch when you do that. You would want to, I would just recommend, if you have things you want to go on the debit card, like the prescriptions, you pay for those in one order. You're going to pick up some lipstick and something else, you put that in a different order.
Yeah, we just don't pay for your lipstick with the.
Or you can come up here.
Hello. Well, there's a little bit of an honor thing in here. You can certainly spend the money on other things, but you are supposed to keep all your receipts. And then if you are audited by the IRS, then you will be penalized, and you will have to pay the taxes. So you get taxes, I think it's 20%, something like that, and then the penalization. So it's like, you want to take the risk? I wouldn't, but it's up to you.
Clara?
Well, I was just going to comment that we've had one of those cards before, and it's just an honor system, and if you use it someplace accidentally, because I've had to do this, and go, like Central Bank is who managed ours, and you just had to go to the bank and tell them to switch it, credit the account back, like move your money around. But I don't know how that would work in this case if you accidentally used your card, if you can go back to the
Well,
company that...
this actually will be through Central Bank.
Okay.
Yeah, so,
So you could just go to Central Bank and talk to somebody there and just have them move the money around from your account, because yes, you have to keep it for tax purposes, proof. But I had a question on an example whenever I've used this account as well. Say in January, we had a dentist appointment, and it cost more than the amount that's been put into my account yet, but it's went ahead and paid out from like ASI. How will that work in this now with the cards? Is it only going to be the amount that's in there for the whole year, or?
When you get the card is already loaded with the entire amount.
Okay.
So you can spend everything January 1st or not. It's already loaded.
Okay.
2 questions. What do you do when you lose your debit card? And can you go on a website and check your balance?
Yes, there is, it's called guardiananytime.com, and then you go check your account. You can see your claims, your balance. You find a lot of things, reports, contact information. If you lose it, if you lose your car, you can call the number in there immediately, and then they will tell you what to do. Okay?
So what happens if you terminate and you've spent all of the money that's on the card? And you've not put that much money into the account?
Well, that's a risk. So at the end of the year, if you don't spend it, then you lose it. But if you already spent it, then somebody else is losing because the card is already loaded.
Any other questions?
That's basically the risk that the city takes by having the flexible spending account is they put the money in on a preload basis, and if an employee happens to spend that money in January and then they leave in February, the city basically eats that money.
Yep.
Any other questions? Anything else, anything Guardian related or unreimbursed medical child care related? Okay. Thank you. Thank you. Okay. Now we're going to talk about health insurance. Okay. Health insurance, this is where our big change is this year. We will still be with United Healthcare, but for the first time in a really long time, you'll have the option between 4 different plans to choose from. So you can choose the plan that best meets the needs of yourself and your family. What I'm going to do is just talk briefly about the 4 plans. I'm just going to kind of highlight the big differences between the 4 plans and give you some tips to how to remember which plan is which. And then I'm going to turn it over to Tanya Harrison, and she's going to go into more details about the 4 different plans, okay? Okay, so there's 2 middle plans, okay? Those 2 middle plans are the FlexPoint and the Navigate, okay? If you have health insurance with the city right now, and you say you have employee and children with the city right now, and you choose employee and children, either Navigate or FlexPoint plan next year, your premiums will be the same, okay? So the employee's cost for next year with the FlexPoint and the Navigate are the same as what they are this year, okay? That's pretty cool. However, we then have the option of, if you want to buy up to a plan that is a little bit more, that is more rich, that is much more similar to our current plan, and that is the traditional plan, you can buy up to that plan, and it's going to be a little bit more money on your, out of your pocket each month, out of your paycheck, so the premiums are higher, but the costs when you go to the doctor are going to be a little bit lower, okay? And then we have the buy down plan, and that's the health savings account. So that plan is a little bit, is less money out of your check each month, but it's more money if you go to the doctor, okay? So what are the major differences between the 4 plans? The FlexPoint plan. The FlexPoint plan, keep in mind that's one of those 2 middle plans, that is a hybrid of a traditional plan and a high deductible plan, okay? The way to remember that is it's FlexPoint, and it kind of flexes between a traditional plan and a high deductible plan. The way that it flexes between the 2 is that if you go to the doctor, you would pay a copay the first 4 times you go to the doctor in a year, and that would be for each person in the family, okay? So if you have the family plan, you have a spouse and 3 children, each of the 5 of you get 4 visits to the doctor, okay? And that can be your primary care physician, that can be a specialist. If you see a nurse practitioner that's in your doctor's office, that would be considered one of those 4, okay? And then we have the buy down plan, and that's the health savings account. So that plan is a little bit more, that is more rich, that is much more similar to our current plan, and that is the traditional plan, and that is the buy down plan. So if you have the family plan, you have a spouse and 3 children, each of the 5 of you get 4 visits to the doctor, okay? And that can be your primary care physician, that can be a specialist. If you see a nurse practitioner that's in your doctor's office, that would be considered one of those 4, okay? And if you go for your preventive care, though, for your annual physical, that is not included as one of the 4, okay? So that preventive care, annual physicals for everybody in the family are still covered at 100% and do not go to the 4. Once a person, though, in the family, say I go to the doctor for the 5th time in a year, and it's the 5th time that's not counting one of, my annual physical, then I would pay the deductible. I would no longer pay a copayment, I would pay towards the deductible. So I would pay the full cost out of my deductible, okay? The deductible is $500, and then it's an 80% plan after that. So once you pay the first $500, you pay 80% of the insurance pays 80% of the expenses after that, and you would pay 20%. Okay, so that's the flex point. That's kind of the big difference in the flex point. The Navigate plan. The Navigate's the other middle of the road plan, okay? The Navigate is very much like the old HMO plans. You guys remember the old HMO plans? Some of you are saying no, it's because you're too young. Some of us old timers remember the HMOs. But with an HMO plan or the Navigate plan, you have a primary care physician, okay? You go to that primary care physician, you can go unlimited times for the copayment, okay, so you're not locked into a certain number of copays. If you need to go to a specialist, though, you have to get a referral from your primary care physician, okay? You can't just go to a specialist without getting a referral. So your primary care doctor is going to help you navigate through the health system, okay? So that's how you remember that's the Navigate plan, where your doctor's helping you navigate through, okay? Couple things on that is that it's a $500 deductible also, and it's also an 80-20 plan. So after you pay your $500 deductible, the system would pick up 80% and you would pick up 20% of your expenses after that for anything that doesn't fall under a copay. Okay? The other big thing about that plan that you want to keep in mind is that it does not have out-of-network benefits. So if you regularly go to a doctor or a health center or something that is not in the network, you're not going to want to be in this plan, okay? 2 things about UnitedHealthcare's network, though. UnitedHealthcare's network is very broad, and it's a nationwide network. So, for example, I have a daughter in school in Springfield. Plenty of doctors and hospitals and choices in UnitedHealthcare's network. It's not a problem to have her being in Springfield and be able to get coverage that she would need through this plan, okay? Broad network. Oh, an emergency. If you happen to be on vacation and you have an emergency and you need to go to the ER, you fell and broke a leg, or you think you're having a heart attack or whatever, they cover emergency services as in-network regardless. Okay, so you never have to worry about emergency services. If if you're in the middle of an emergency, you just go get the help you need. They will pay it as in-network. Okay? Okay, so that's the Navigate plan. Sure. Well, she says it's a quick question, so.
So, do the co-pays go towards your $500?
Yes, co-pays, all co-pays go towards your deductible on all of these plans. Well, the high deductible plan, the health savings doesn't really need it, but yes. Hey, Drew, since you're doing such a great job.
So with the 4 visits, it's 4 visits total, even if it's one to a different doctor 4 times, not 4 visits per doctor. Is that
Right,
correct?
it is 4, however, urgent care gets 4 visits. A doctor gets 4 visits. Hopefully nobody goes to the emergency room 4 times in a year, but the emergency room would get 4 visits. So each of those are different. But primary care and specialist are lumped together, okay, and nurse practitioners. Those are all lumped together as far as 4 visits. Okay.
On the Navigate plan, it says you have a primary care physician. Let's say you choose a pediatrician at JCMG, and you choose one doctor as your primary care, your kid's sick, they can't see the primary one, but somebody else in that practice. Does that count as the same?
Yeah, because they're actually practicing under the same tax ID. I did.
Okay, because that was my main thing, because and same with your, like, my primary care, if I can't get in and I go to what they have, like, called extended care clinic to see somebody else in their practice, it's still only going to be the $30 copay, not,
Yes, it should, as long, again, as long as they're under that same tax ID umbrella, then that should be fine.
okay.
And as long as they're still billing it as an office visit and not as an urgent care.
And it's 4 per person?
4 per person.
So does
And
that,
it's not a total that you can mix and match? So Jeremy's got 14 kids.
Yeah, no.
He can't, okay.
Nope, it's 4 per person.
okay, so I can't use, my
can't
kids
use your
can't use
kids'
my
visits.
visit. Well,
No.
no, it's the other way, yeah, it's the other way around, but okay, that's
Nope.
what I'm checking on.
Okay.
You said 4 emergency room visits, but they don't have a copay, so
They don't have a copay if you're admitted, correct?
none of them do on the flex point. If you're admitted, you don't.
Emergency room under the flex plan does not have a co-payment. But
Right, so
you-
it doesn't matter. You can
Yeah,
go to the
it does-
emergency
yeah,
room as
there are
many
no
times
copays
as you
on
want,
our
'cause
Okay, so my bad. So emergency room, there is no copay on emergency room. That just goes to deductible and coinsurance. Okay? Thank you for catching that, Lindsay.
And how is pregnancy covered under this plan?
I'm going to have her talk about pregnancy on,
Okay.
and compare it across all 4 plans. Okay, let me keep going through and just do the brief, because then I really want Tanya, she really is going to go into more detail about each of them. So let's do that, if you guys don't mind. The traditional then, the traditional is, remember, is that's the most current, most similar to our current plan. Okay, that is, it has a $1,500 deductible though, as opposed to what you guys are kind of used to seeing really is a $500 deductible. And then it pays 80%. Our current plan pays, no, I'm sorry, traditional pays 90% still, like our current plan, okay? The co-pays increase on the pharmacy on there. So that plan mainly, its big thing is it's a higher premium, $1,500 copay, deductible, and a little bit higher copay on pharmacy. And then you have the health savings account, that's our buy down plan. Okay, so on a health savings account, you have lower premiums, but you have a $2,600 deductible. Okay, and you have no copays on that. Once you've met your deductible, you would then have a copay on your pharmacy. Okay, but on your office visits and stuff, you wouldn't have copays. You'd have the deductible, and then it's a 90% plan after the deductible. On that, the city will contribute, because that plan is less expensive, the city's still paying the same amount of money for each person regardless of which plan they choose. So the savings in that, we automatically will take the difference and put that into your health savings account. Okay, so that difference is $68.45 a month. So if you sign up for the health savings account, we will automatically sign you up and put $68.45 per month into your health savings account. One of the things that I am highly recommending, and it's totally up to, each individual and your circumstances, but if you choose that plan, so say you have, the family plan now, and you choose the family plan health savings account, your premiums are going to go down. I highly recommend you take that difference, instead of having your premium go down, take that difference and put it into your health savings account. Okay? If you do that along with what the city contributes, you would have $2,300, almost $2,400 a year going into your health savings account. Okay? So, and that would go towards, of course, your family deductible then would be $5,200. So, if you can put more than that in, I highly encourage you to do so. The maximum you can put in is $3,350 for singles, $6,650 for family. So I highly encourage, if you go with one of those plans, that you put the most in as that you can the first couple of years and get those accounts built up. A couple things to keep in mind about those plans: that is your money. Okay, even what the city gives to you, that's your money. So if you end up leaving employment with the city, that money goes with you. Okay, and you can use that then with future plans for out-of-pocket expenses, co-pays, and things like that. And you would get a debit card for that, And it works very much like an unreimbursed medical does. So you can also use it for dental expenses, contacts, glasses, and things like that. If you enroll in the health savings account, though, you cannot also enroll in the unreimbursed medical. Okay, by law, you can only choose one or the other. So there is definitely more flexibility with the health savings account because it is not a use it or lose it like the unreimbursed medical. Okay. I think that's the primary things I want to make sure that I covered. So I'm going to turn it over to Tanya and let Tanya go into more details about the plans. And then once she's done that, I'm sure you guys are going to have lots of questions about those plans and we'll talk about them. So.
Thanks, Gail. Okay, you guys have a lot of paperwork in front of you, and I'm going to just steer away from the plans for just a minute, okay? You have a packet in front of you, and you don't have to open it. But inside of it, you do have a member booklet this year. Instead of a bunch of flyers, because we knew you guys were going to have so much paperwork anyway, we decided to put the booklet in because this talks about the myuhc.com website, the nurse line, the Care 24, all those good things that you have as members, just all in one nice location, okay? The other thing that is inside of your packet is your prescription drug list, and this tells you where your prescriptions fall as far as what tier they're going to be under, so always refer to this, please. And last but not least, you have the mail order prescription request form. Definitely encourage mail order prescriptions. If you take a maintenance medication, something you take on a daily basis, look into doing mail order because it could be a cost saver for you. You get that 3-month supply or 90-day supply for 2.5 times your copay, okay? All right, now we'll go back into the plans, okay? It's kind of like in my face here. You have a plan comparison that we put together so that all 4 plans are right there in front of you. Hopefully this will help make your decision a little bit easier in deciding which plan is going to work best for you. But I'm going to go over this. If you have questions, please let's go ahead and ask them as we move along so that you don't forget the question. First, the traditional plan. Now this plan has an individual deductible of $1,500 and a family deductible of $3,000. Once you meet your deductible, that cost sharing kicks in or coinsurance kicks in of 90/10. So at that point, once you've met your deductible, United Healthcare starts paying 90% of the charges. You would be responsible for 10% of the charges, and you'll pay that 10% until you reach your out-of-pocket max, which is $3,000 as an individual and $6,000 for the family. If you hit that threshold, those services are then covered at 100%. Okay? So nothing's changed with that, but just want to explain all of that. Your primary care doctor visits have a $25 office visit copayment. Your specialist visits have a $50 copayment. Preventative care is going to be covered at 100%, and that's across the board for all 4 plans. Emergency room under the traditional plan is a $250 copayment. Urgent care is a $75 copayment. Hospital services fall to deductible and coinsurance amounts. And then on the second page, it talks about your pharmacy, and with the traditional plan, there is no separate deductible for pharmacy. It's straight 3-tier copayment, and it's tier 1 is $10, tier 2, $35, and tier 3 are $60. Okay? Any questions on that traditional plan? Okay. Moving on to the HSA, the Health Savings Account. Now, the way we have to look at this plan is that it has 2 parts. You have the health plan itself, and then you have the HSA, the Health Savings Account, that is tied to that plan, okay, and they work together. But we're going to talk about the health plan first. This plan is a qualified high-deductible health plan, and it has an individual deductible of $2,600, family deductible of $5,200. Once you have met the deductible, the cost sharing or coinsurance is 90/10. So again, you would pay that 10% until you reach the out-of-pocket maximum. On this plan, $3,600 for the individual, $7,200 for the family. Okay? Now, the thing to remember about these plans is there are no co-payments for any services. This is what I like to call the true deductible plans. What you have to keep in mind is everything you do, all the services that you get, will apply to your deductible first, okay? And then, again, once you've met your deductible, the coinsurance and everything. But there are no co-payments, not for prescriptions either, okay? So doctor visits, ER, hospital surgeries, things like that, and your prescriptions all go toward filling that deductible bucket, all right? So as you kind of scan down here, you actually see 90% after deductible, 90% after deductible on all categories, except for preventative, of course, which is covered at 100%, okay? Now, if you'll flip back over to the pharmacy side, there's two things that happen when you meet your deductible, okay, under the HSA plan. The first thing under your medical side is your benefits then kick in at the coinsurance level, okay? On the pharmacy side, that's when your co-payments kick in. And the co-payments are 10, 35, and 60 on this plan as well, all right? So deductible first, then coinsurance on medical, co-pays on pharmacy. You'll pay those amounts till you reach that out-of-pocket amounts, okay? Any question there on that, the
I got
plan
a
themselves?
whole bunch. I got a whole bunch, actually.
So do I.
Maybe not a whole bunch, but I got several. Did I cut somebody else off? Oh, Brett. No, screw it. So on day one, I haven't paid anything into my HSA, and I go to the doctor. How does it work?
HSAs are like, and I'm going to talk about that, and then let's do the questions, okay? Because the
Okay, so-
HSA
okay.
works differently than the flexible spending account. An HSA is just like the bank account that you open up, okay? The money goes in on a monthly basis, and it grows and grows and grows, okay? If, let's say, you know, January, you have the $68 that the city puts in, and maybe you're putting in 25 more, so that amount's in there, but you go and goodness, all of a sudden you've got to have a surgery done, and they've scheduled it for February 1st. Of course, no, the money is not in your HSA. And I speak from personal experience because my husband did have this situation happen. But what happened with my situation is I worked out a payment arrangement with not only the doctor, because we owed him money, but also the hospital as well. So as I put money on a pre-tax basis into the HSA account, then I worked out that payment plan to pull that money out of the HSA to pay the bills to the doctor's office, and I paid that over the course of a year. You know, people work it differently. If you're lucky enough to have that large amount of money sitting in maybe your savings account, and you can pay those hospital bills on February 1st, by all means, you can do that. And then as your HSA grows to that amount, you can actually reimburse yourself from the HSA, because you will get a debit card, and you can just take it to the ATM, swipe it, pull that money out, and pay yourself back. Okay, and you can also opt for checks under the HSA as well. Okay.
So can you reimburse yourself later on or
Mhm.
not? Okay, so I pay it all on January 1st, and then February finally there's some money in, I can go in and take that out.
Absolutely.
I think most of my questions related to the HSA, so you want me to wait?
Yeah,
Okay.
let's do. And then, because I might answer some of them throughout this, but then we'll go to it, okay? Okay, so I've already talked about the HSA. You are the bank owner, or the owner of the account on this. And so the one thing to keep in mind are these accounts are triple tax advantage accounts, okay? Number one, the money goes in on a pre-tax basis. If any interest is earned on these accounts, that money is also tax-free. And as long as you're spending the money on qualified medical expenses, it's always going to be tax-free. So triple tax advantage, okay? Now, and Gail's already talked about this a little bit. You are the owner of these accounts, okay? These accounts are portable as well. So once that money goes into your HSA account, it belongs to you. It never can be pulled back by the city or anything. It's your money, okay? But example number one, let's say you leave the city and you go to another employer, and that employer has an HSA account as well. But they don't use Central Bank. They use some other bank. You can actually do a transfer from HSA to HSA, penalty-free, tax-free, okay? The other thing is, or other example is, let's say you go to an employer who does not have an HSA account. They've got the traditional account with co-pays, et cetera. Now, you still have that HSA money sitting there. And remember, it's your money. It's always your money to spend on qualified medical expenses, so you can still spend the money out of that account. The trick is you can no longer put money into that account. Okay, you can't grow that money anymore. All right? Now, there's a couple of rules that the IRS has set up as far as who is eligible to have HSAs. The first rule, you have to be covered under that qualified high deductible health plan. The second rule is you can't be covered under another non-qualified plan. So take, for example, you work here at the city and you have the city's insurance. Your spouse works somewhere else and has their employer's insurance, and it's a great plan and they want to cover you as well under that plan. If that plan is more like that traditional plan that has co-payments for doctor visits, and it's not a what we call the high deductible health plan, qualified plan, that makes you ineligible to open an HSA. Okay, so be careful with that one because a lot of people kind of get stuck on that one, all right? Some other rules are, and I think Gail mentioned this, you cannot have a flexible spending account and an HSA in the same family, okay? So be careful with this one as well. If you have the HSA here at the city, your spouse is employed somewhere else and they have an FSA, the government says no, because the government looks at you as being as one entity. You can have one or the other in one household, okay? So be careful with that one too. Also, you can't be enrolled in Medicare, and last but not least, you cannot be claimed as a dependent on somebody else's tax return, okay? Now, what can you spend your money on out of the HSA? I've said it several times, qualified medical expenses. And that's a wide range of things, doctor visits, hospital visits, but it also includes vision, dental, orthodontia. There is a nice list out on myuhc.com, so I would suggest going out there to look if you have any questions about it. Also, the government, irs.gov, has a great list as well of qualified medical expenses. Now, one thing I want to mention at this point is, let's say you've been in an HSA for 5 or 6 years. You've been very lucky, no medical expenses to speak of, and let's say you've got $5,000 sitting in that account now. Well, then all of a sudden, the car breaks down, the air conditioning in the house goes bad, so you're thinking, okay, how am I going to pay for all of this? And you go, oh, I've got that HSA money sitting there. Well, that's fine. It is your money, but the government says this money was put into the HSA account to spend on qualified medical expenses. If you do not spend it on qualified medical expenses, the first thing that happens is you're going to pay the taxes that you did not pay on it originally, and you're going to have a 20% penalty on whatever you spend as well. So my suggestion is just leave that money in that HSA account because it will always be there, and we are all going to have medical expenses at some point in our life, okay? All right. Now, contributions into the HSA, I know we've talked about this a little bit. It's from your payroll deductions. That's how you get your pre-tax basis. One other thing I want to mention is, same kind of a situation, if you have something that occurs, early in the year and you don't have a lump sum of money in that HSA yet, the government does allow a one-time rollover in a lifetime from your IRA that you might have into the HSA, and that's a one-time per lifetime. And that's penalty-free, tax-free, okay? So that's a nice little option that they've added there, okay? Now, some other limits that the government have put on these accounts are how much you can contribute into the HSA each year. If you have an individual policy, you can put in $3,350 in the year 2015. If you have family coverage, you can put in $6,550. If you happen to be age 55 or older, you're allowed to do an additional $1,000 each year on top of those contribution limits, okay? Now, consumer experience, how the real world works out there with these HSAs, doctor visit. Today, most of us are used to going in and paying a co-payment for our visit. Not so with the HSA plan, because remember, there are no co-pays. It's a deductible plan. So I call this plan wait for the bill to come to you. Okay? When you go to the doctor's office, you're going to see the doctor, you're going to leave that day and not pay anything. Okay? When you get done, that doctor is going to submit that claim to United Healthcare, where we are going to actually apply our discounts because you went to that in-network doctor, and so we have a contract with them. So we apply our discounts to the amount they charged. So let's say they billed $100. When we get it, we discount it to, let's say, $75. So you're going to get an explanation, and as is the doctor as well, that shows $100 was billed, $75 was allowed, $75 has now been applied to your deductible because you haven't met your deductible yet, and at that point the doctor's going to know to bill you for that $75. Okay? You take your HSA card, and when you get that bill in the mail, just fill that out and mail it back to the doctor's office, and they'll deduct that $75 from your HSA. Okay? One note, make sure there's $75 in your account, because they're just like your checking accounts today. There will be overdraft fees. Okay? So just make sure the money's there. Now, pharmacy works a little bit different. It's a real-time claim action. And so when the pharmacist runs your medical ID card, they're automatically going to know what the discount is on your prescription. Okay, because remember, no co-payments for prescriptions in the beginning. It goes to deductible. But the great thing is, you still get the discounted amount. Okay, so they will apply that discount right there. And then you just swipe your card just like we do with the credit card machines. Okay? Now, one last very important thing, record keeping. You are responsible for keeping records of how you spend your HSA dollars. Okay, so every time you write that bill to that doctor's office, keep a copy, keep the second half of the receipt, throw it in a file folder. Prescriptions, keep the receipt, throw it in a file folder. Like I said, I've been on an HSA for probably 6-7 years now. I have a file folder for each year, have those receipts in there, so that if the IRS ever comes back to me and audits and says, hey, it looks like you spent $300 out of your HSA this year, prove to us that it was spent on qualified medical expenses, all I have to do is hand them that file folder, and I guarantee you those receipts are in there, and not for the, the air conditioning or the car, things like that. Okay, so that's how they kind of monitor that. So record keeping is your responsibility. Okay? Questions?
I'm ready. All right. Did you say there was a debit card?
You can get, debit card is the first way to go, and you can also opt to have checks as well.
Okay, you answer my second one. Does does anyone have to approve the medical treatments you receive?
Depending on what you have.
Okay.
Yes.
Give me an example.
That's a good one.
I'll give you an example.
Okay.
Someone has stomach problems and wants to go get their heart checked out. Okay? Primary care physician might say, no, you don't need it.
Well,
let's say there's a disagreement between patient and primary care. I assume primary care doesn't matter. It's not an HMO.
Right.
So
you can go to
you
any
control your own
specialist you
destiny?
want.
Okay.
Right, under this plan. The Navigate plan would work differently. You would have to
Right.
have that referral from that primary care doctor
So in this
before you
case-
can go to the specialist. But if you are under this plan, you can go to any specialist you want to at that
So
point.
any qualified medical expense you can spend your money on?
Yeah.
Okay.
Absolutely.
What about after you hit your deductible? Your maximum out of pocket, same thing?
Yeah,
Yep.
absolutely.
That's interesting. What's a major medical diagnosis deduction? I saw those in all 4 plans.
Major medical.
Well, I'm sorry, this was on the sheet, maybe Gail gave it to us, it might have referred something different, but it says, this is under our ER bill, urgent care ER major diagnosis copay, I'm sorry, that's what I meant to say. Is there a difference in major diagnosis? Is that treated differently in any way?
No.
Okay,
No,
I might have misunderstood that. You answered my IRA question.
Okay.
The money is held by who then? Central Bank?
Central Bank. Mhm.
And it earns interest at what rate?
And that I can't answer because I'm not from Central Bank and I don't
Okay.
know that, so I apologize.
Yeah. Is that something we can find out from somebody at Central Bank, I guess? Can you grow it beyond the 6,500? You can only contribute 6,500 per year, but you can continue to grow as much as you want.
Absolutely, yeah, those contribution limits are just a per year limit, but absolutely, that money is, the way the government set up these accounts was for you to have money in your quote-unquote golden years to have for medical expenses, so absolutely, that's the goal, is to put in as much as you can each year to
Okay.
grow that money, yep.
And preventative care is covered 100%.
On all 4 plans.
And where do I find out what preventative care is?
You can go to myuhc.com or www.uhcpreventativecare.com, and that takes you right there. And you
Okay.
plug in your age, and it'll give you a list of everything considered preventative. And of course, because of healthcare reform, preventative care is kind of under what I call an umbrella now, and it is very specific based on healthcare reform on what is considered preventative care. Okay.
If I get pregnant and my pregnancy goes over 2 years, does the deductible start over again?
Yes, it does.
And all right, I know. Well, no, certainly, I would think most pregnancies cross 2 years unless you're just, amorous at the beginning. And pharmacy, and I think Gail can answer this, but pharmacy and deductibles apply to that $2,600 individual or $5,200 family.
Correct.
This probably falls under what a qualified medical expense is, but are you familiar with the MD VIP, where you're basically paying for kind of a concierge doctor?
Absolutely.
Covered or not covered?
Not covered.
Braces covered or not covered?
Braces in the teeth or legs?
Teeth.
That would be under your dental plan and Dulce?
You can't use HSA money for that?
Yeah, you can.
that
Sorry,
really
I
my-
thought you meant was it covered
I'm
under
sorry.
your dental plan?
I'm sorry.
Yes, yeah, you can, yeah. I spend mine on my kids' orthodontia.
And that pays down the deductible as well.
Not on your medical plan, no.
Okay, that's really the question I've got is when do things, I kind of drilled around it here, but how do we know what applies to the deductible as opposed to what applies to the qualified medical expense?
One easy way to do it is, did you present your United Healthcare medical ID card, or did you present your Guardian dental card when you got the service for like braces? Okay?
Okay.
If you have your United Healthcare ID card and you submitted it, or, you did it for that service, like at a doctor's office or a surgeon or whatever you may have had done, then that claim is going to run through United Healthcare, and that's going to hit your deductibles and such under your medical plan. But if you submitted your Guardian ID card for that orthodontia service, and it's hitting your orthodontia deductibles, whatever it may be out there and out of pockets, then no, it's not going to hit your medical plan because it's not going through your medical plan.
I kind of get that,
Yeah.
but I may have just missed your point there. But if I can use money from the HSA on orthodontics,
Yes.
but I wouldn't use Guardian for that. I would just pay that out of my HSA.
You would use the Guardian for your orthodontia, quote-unquote, benefit,
Okay.
okay? Yeah. You can spend your HSA dollars. That's the nice thing about
Okay.
the thing is it's just money that's sitting there to spend on all qualified medical expenses, okay? Everything that is under your medical plan, yes, but then, yes, you have your dental plan and vision as well,
That was
okay?
the other thing. LASIK was my kind of
Yes.
follow-up question.
Yeah, and LASIX, absolutely. So, no, you're not going to run LASIX through your United Healthcare card, we'll say. So, no, it's
Okay.
not going to hit your deductibles and such. But yes, that's why I say look at these as two separate things. You
Mhm.
have your plan, your health plan itself, and then you have your HSA.
Okay.
Because you can spend those HSA dollars on a lot more things than just your medical plan services. Does that help?
Yep,
answer
yep,
that?
yep.
Okay.
And, hey, I'm not done. You shut up, you. How do you like it?
I love it.
Why?
Because, well, number one, first year I was there, got to grow the money. Second year I was there, my husband had 2 surgeries, definitely wiped out what I had put into that HSA, plus I made those payment arrangements, okay? Couple years, we've gotten to grow the money again. Well, guess what? My husband had surgery last week. It's really nice when that money is sitting there to pay for that deductible. I didn't have to worry about a thing. I just said, here's my HSA dollars. It's a 20% tax savings. I'm saving premium dollars on it. It works out well for me. So it's not for everybody though, okay? Keep that in mind. It is not a plan for everybody.
Now that you've finished the cross-examination, I'm sorry. You mentioned the IRA transfer. Is there a limit to that? Is it the same limit as the 33?
It is. You can't put any more in than what that yearly contribution limit is. So if it's $65.50 for the family for 2015, that's what they will allow you to transfer over that one time.
By proxy, I have one more question. Who is the HSA not for?
It is not for, it depends. If you're a really low-end user, I mean, in my opinion, it's good for a lot of things, but this is the way the spiel goes. It's not always the best option for a low-end user because you're meeting deductibles and things like that. I don't agree with that totally because, in my opinion, the money that the city puts in there for you plus the money that you can put in there for yourself is money that you can spend later, okay? The other scenario is very high-end users. And you know what? I am saying this backwards. So let me start over. It is very good, so I did do this backwards. It is very good for low-end users. It is very good for high-end users. It is not the best plan for middle users in the fact that the money that you're putting into the HSA, you're constantly taking out. So, you're one that goes to the doctor maybe once a month or at least every couple months. Maybe you're following a medical condition and you have tests run. So you're not able to grow that money, okay? But again, you have to look at it as an individual and your own situation because, in my opinion, it's a good plan when you can work with it. And based on premium savings, the 20% discount, look at all avenues and look at the 4 different plan options. You guys have to pick out which plan's going to work best for you, okay? So, each one of these plans is not going to work for every person in here. That's why they're giving you 4 different plans to choose from.
So you said that you can't have an HSA and a cafeteria plan in the same household.
Correct.
My husband works for a company. He has a cafeteria plan through that company and maintains their insurance. If I'm here, if he did not have that cafeteria plan with his company, I could have an HSA. Am I then allowed to use my HSA money to cover his medical expenses as well, even though he's not covered by the high deductible plan? He's
Yes.
covered by his own insurance.
Yep, that's a very good plan. That is one nice stipulation that the IRS has put into these plans. Let's say you cover yourself and yourself only here under the city, your spouse covers himself or herself and all the kids under their plan. You can spend, any HSA dollars that you have in your bank account, you can spend on any dependent in your household, okay? You can't spend it on grandma, and you can't spend it on aunts and cousins and things like that. They have to be taxable dependents within your household. But yes, that's a nice feature.
And I was wondering, the HSA plan, so do they require beneficiaries to set them up?
Yes, they do.
Is that
Yep.
beneficiaries? Okay. And you mentioned the 55 catch-up plan. You can add the extra $1,000.
That is if you are age 55 or older.
What about the spouse? If they're 55 or older, do you get additional too?
Nope, actually, the HSA would be opened in the employee's name, and so you, as the employee, would be the owner. If you're under age 55, you would not be allowed to make up that $1,000 contribution, even if your spouse is over that age 55.
Okay, so it's just the age of the employee.
Yes. Then it would be a prorated. That's a good question. Yeah, and Central Bank would be able to answer that for you, so you could call and ask them, but basically, let's say that $6,550 that you're putting in and the additional $1,000, you would not be able to put the whole $1,000 in. It would be prorated based on your birthday.
And I was also reading about a testing period, probably along with that. If you add more money, a testing period.
Testing period?
Yeah, I just saw on one of the IRS websites that there's a testing period when you add more money in, that there's a delay. Or
I've not heard of that, but I can definitely, if you want to bring it over to me afterwards, I'll write it down and I'll take that as a takeaway.
Oh,
Yeah, it's on the frequently asked questions of the irs.gov. I saw the same thing. I didn't understand what it was talking about
Yeah,
either.
I've not heard of that. I've done this a long time, so. Anything else on the HSA?
Okay, I've got a
I
question.
thought you had something.
Well, this is actually, I guess I had 2 questions. The first one was on oral surgery, like to have your wisdom teeth removed.
Right.
Does that go through medical, dental, neither, or both?
Dental?
That's dental? Okay. I wasn't sure. I mean, I think most of the time it's pretty clear, but on that one I was just curious.
Yeah. Yeah, dental, it would be covered, but if you're under the HSA, you can use your HSA dollars to help pay for it.
Okay. And then, I mean, I think my other question, I think you pretty much already answered, which is if you're somebody in the middle, let's say you've got 3 kids, they all see specialists, hypothetically speaking. So basically, I mean, I run the risk of putting in all this, this extra work to do all this, and it's just washing out. I put it in, I'm taking it back out.
Right.
As opposed to, if you're, a single person or you're, a couple with, either way, I think, I mean, would you agree with that statement? That, I mean, I recognize you aren't recommending any one plan to any, I'm just saying, in general, would you agree that that scenario might fall into the middle of the road.
Absolutely.
Okay.
Yeah, because you just have to look at it as, and again, it's putting pencil to paper on each of these plans, especially the HSA plan. You know, number one, calculate your premium savings. And you guys have been with United long enough, myuhc.com under your claims. What I would do is go back and you can actually run an Excel report right from the website. You can see how much did I spend on my kids or whatever, just on total doctor visits and things like that. And you will be able to see what you want to pay attention to is that allowed amount column, because the allowed amount is what you would be responsible for in paying up front under the HSA plan. So again, calculate premiums, calculate allowed amounts on what you spent in the past. It's not going to be the same in the future, of course, but that gives you a good idea. And, you know, and then see what you can chunk into that HSA and see if it's going to even out. So.
Thank you.
Mm-hmm. You know, I haven't looked at
Yes.
prescriptions lately. Okay, he says yes, so.
On the 6,600 max, if you dump in from an IRA, does that count for the single year? So
It does.
So anyone who wanted to do that would only dump in whatever it is less, 6,600 less
What the city
what the city's
pays.
throwing in.
Right,
Okay.
right, yeah, yeah. And they really did that just for those kind of, oh my gosh, I had a surgery in the beginning of the year, and that was one way for people to have that money transferred over. So, unfortunately, is one per lifetime.
Is that something that you contact Central Bank about?
Yes, absolutely. Yep. Okay, anything else on the HSA? Okay, last but not least, Navigate plan, okay? No, we're only on the HSA. We need to go over FlexPoint still. Woo. Okay, FlexPoint. I know Gail's talked about it, but $500 individual deductible, $1,000 family deductible. Once you've met your deductible under this plan, it's 80/20. You'll pay that 20% to the out-of-pocket max of $4,000 individual, $8,000 family on this plan. Primary doctor visits and specialist visits. Primary copays are $30, specialist copays are $60. Please remember there are 4 visits allowed at copayment level in this category. Okay, once you hit your 5th visit, it is going to apply to your deductible and coinsurance levels. Okay, still not a bad plan. It's $500 deductible, so don't get scared from that. Preventative care always covered at 100%. Emergency room, no deductible. It is deductible or no copay. It's deductible and coinsurance. Urgent care, you have a $75 copayment, and there are 4 urgent care visits allowed. Again, 5th visit is going to apply to deductible coinsurance. Hospital stays, deductible coinsurance. Pharmacy benefit, 3-tier copayment, $10, $35, and $60. Okay. Any questions on that one? All right, now we'll move to Navigate plan.
Wait a second. How is pregnancy treated under this plan?
Good question. Actually, you have a specialist copay in the beginning of a pregnancy, so that would be one of your copays that is used toward your 4 visit. You don't get charged a copayment each time you go to your OBGYN for your maternity visits. What happens is you pay that first copayment up front, and then at the end of the pregnancy, they do what's called a global billing. And then you'll get billed at that point for that service. Those services then get applied to your deductible and coinsurance. Okay? Yes? It does. So that is a very good question. We have a couple, actually, I think it's just the one here in town.
Could you repeat it so
Yes, I
that
am.
the audience at home?
Yeah. We have an urgent care center here in town that will, at some point, for some reason, they bill as a office visit, like a physician setting, instead of an urgent care visit, which is great because then you're only paying your specialist copay and not your $75 copayment. But under the Flex plan, be careful because that copayment then applies to your primary care specialist visit bucket, okay? It doesn't apply to your urgent care bucket because they've billed it as a physician visit. But that's a good question, thank you. Yes?
Is there something that we can tell how many visits we have left under each of those categories?
MyUHC.com. You always have access to all of your claims out
So
there.
it will separate, like, you've had 3 primary cares?
It's not going to be
or-
that specific. It's not going to go out and just say, here's 4, -1, -1, -1. No, you're going to have to look and see, okay, here I went to my doctor 3 times, I know I've got 1 left. So,
Okay, so if we go to that urgent care
mhm.
and we get charged like a
Doctor visit?
like a specialist visit, then we still have 4 urgent cares left,
Yes,
and then 3 specialists. Okay.
right, yeah. Good? Okay, move on to the Navigate real quick. The Navigate plan has an individual deductible of $500, family deductible of $1,000. Once you've met your deductible, cost share is 80/20. You pay the 20% till the out-of-pocket max of $4,000 for the individual and $8,000 for the family. Primary doctor visits are a $30 copayment. Specialist visits are a $60 copayment. Now, 2 things before I move on. First and foremost, this is an in-network plan only. There are no out-of-network benefits under this plan, okay? So if you are somebody who always goes to the doctors that are in-network, might be a great plan for you. If you're somebody who likes to go to different towns and different cities and different states for things, do your education first. Make sure they're all in network. Again, it's hard pressed not to find a United Healthcare in-network doctor wherever you go, but there's always that possibility. Okay, it's an in-network plan only. Emergency room services are always covered in-network or out of network at the in-network level of coverage. Okay. Second thing is referrals. If you remember, and there are a lot of young ones in here, if you remember the HMOs from the old day, you got a paper referral from your doctor, and you walked over to your specialist, handed them that referral. Those days are gone. It is all electronic now, okay? So your physicians have all been trained with the new systems on how to do electronic referrals, but my suggestion to you, be proactive. If you are under this plan and you get a referral from your primary care doctor and they say, go see specialist Joe Blow, call Dr. Joe Blow before you go visit him and say, do you have my referral from my primary care doctor? Before you go visit them. If they say no, don't go. Okay, reschedule your appointment until that doctor has your referral. If you see that specialist without that referral, it will not be covered and you'll be responsible for the full payment. Okay, there's no going back and getting a retro referral, etc. You have to have that in place electronically before you visit that doctor. Okay, I'm sorry, getting choked up. Any questions on that?
Is an office visit required to receive the referral?
Totally up to your physician, your primary care doctor. Yeah.
If you do go to an out-of-network doctor for some reason, does that count towards your deductible still or not?
No. No in-network level of benefits at all. You would be responsible for that full charge.
Except the ER, right?
Except ER.
And how do you know when it's an emergency? I mean, presumably, most of us know you break your arm, break your leg, but there's probably some nebulous where you're not going to cover it. Is there a way to know that for sure?
As long as the hospital bills it as an emergency room, and you're at that emergency room, then it's going to be paid as an emergency room visit, okay? Even
Okay.
if you're there for a sinus infection, which we all know we shouldn't do, if you're there and they bill it as that emergency room visit, then it's going to be covered at that emergency room level, okay?
Okay.
Then it would fall to your deductible coinsurance. Yeah,
The question was, what if you're admitted after your...
thank you.
Even in a non-network facility?
Well, that's a very good question. If you are in a condition where you cannot, quote unquote, make decisions, and let's say you go to the emergency room and they decide to put you inpatient and it's an out-of-network hospital, but you cannot make decisions and say, hey, I'm at an out-of-network hospital, I need to be moved in-network, those are going to be covered at the in-network level of coverage until you are able to either be transported to an in-network hospital and make decisions on your own. We would not move a person, that cannot be moved. So yes, those services would be covered in network, even at an out-of-network.
Okay, so if you go to the pediatrician because your son or child has a bad cough, and so you pay the $30 copay, then they send you down to X-ray to get a chest X-ray. Do you pay the other $30 down there, or is that $30 cover the whole everything?
Good question. The $30 covers your visit at the doctor's office. If they send you down to X-ray, X-ray is a major service, a major diagnostic service, that would be covered under your deductible coinsurance. Yep. And same for labs. If they send you somewhere else for lab work, and if they do a blood draw right there at the doctor's office, that's going to be covered under your doctor visit, okay? But if they send you, if you have to walk into another door, that's a completely separate service. That office is going to bill for their services, okay? You're going to get a separate bill for that lab work, and that's going to be deductible coinsurance. Okay? Anything else on that one? Okay, almost through this. Urgent care, $75 copayment. Hospital stays, deductible coinsurance. However, remember, if you're going to go into the hospital for a scheduled surgery, whatever it may be, you have to have that electronic referral before you get that service done too, okay? It's not just to your specialist. It's for hospital visits and such as well, okay? Co-payments are, on the pharmacy side, your co-payments are again, Tier 1, $10, Tier 2, $35, and Tier 3, $60. But again, remember, no out-of-network benefits, but 99.9% of the time, you're always going to find an in-network pharmacy. You know, very, very rarely will you find an out-of-network pharmacy. There might be that one mom-and-pop shop out there, but most everybody's in, okay? All right, we made it through it. Any last-minute questions? Yes?
Yeah, if the doctor's going into your doctor and you need something to look at, you know, either an X-ray or a CAT scan, see what, and he or she is insistent upon CT more than the X-ray. Is it still going to be policy that you have to go through X-ray first and then CAT scan secondary? Because I found that to be the case here in the past.
It depends on the service, and what the question was is if a doctor has recommended a certain service, procedure, depending on what it is, let's say they order a CAT scan for something to be done, however, maybe an X-ray would be more cost efficient. It depends, but as long as your doctor has ordered it, it should be fine at the CAT scan level. Depending on the service and the severity of whatever may be going on, there may be a requirement, and this definitely falls more in that radiology type services where MRIs, CAT scans, things like that are done. They do have to get approval before it's done, and this is all from your doctor's office. The doctors submit, this is why we want this done this way, but because there are certain guidelines that they have to follow under the radiology, if they haven't maybe done a certain thing, then they do require the X-ray first. You would have to get the X-ray first, okay, in order to move on. Again, it's all dependent on what your doctor's office submits on what we call a predetermination for that.
Does that apply to the HSA as well?
It applies to all plans. Okay. Yes. The question is on physical therapy visits, especially under the flex plan where there's 4 visits allowed for primary care specialist visits, etc. Physical therapy is separated out, and you have a $30 office visit co-payment. There is no 4-visit limit on physical therapy, and I believe, and I was going to look here, I believe it's 30 visits. It's 20 visits for physical therapy, occupational therapy. Cardiac rehab goes up to 36 visits. Chiropractor doesn't have a co-payment. It's 50% of billed charges, and that's state mandated law.
For the for the flex plan, does the chiropractic visits count as your office visit?
Nope. Nope, they are completely separate. Yes. Wait.
Backing up to the flexible medical, the $2,500 total, I read where it says that if you're eligible for the medical plan, if you choose to not do the medical plan, you can still do the flexible medical because you're still eligible for it?
They can still do the FSA even though they don't take the medical plan?
Yes, if you don't have, you mean if you don't have health insurance through the city? Yeah, if you don't have health, that benefit's available regardless of what health insurance you choose. I shouldn't say that now anymore, but yeah, if you don't have health insurance with the city, you can still take that unreimbursed medical.
Is that a limited FSA plan for dental and vision in case I'm on a qualified health care plan, HSA plan?
It's a full FSA plan. They don't have the limited.
Okay.
Can we go back just a second, because I was asking Sheila, I wasn't listening. So you ask if the doctor says he wants to do an X-ray or an MRI. So the doctor says you want to do a CAT scan, and you say, no, I want to do an X-ray.
No, the
Okay,
insurance
sorry, I missed
company,
it.
actually.
What was it?
The insurance company is, basically there are guidelines set up for radiology,
Okay.
those types of services. Depending on the condition, again, it all depends on what's going on. Sometimes they will say an X-ray needs to be done first before the CAT scan. But again,
Even
it
if
all-
you're still under your deductible?
Yes, doesn't matter. Yep. It all is based on how your physician submits, like what has been done. So technically, you can't go right into a doctor's office and say, oh, I got a pain in my back. And they go, okay, well, let's get a CAT scan done. That's kind of very obvious in the fact that, well, nothing else has been tried. Okay, but if you're one that maybe has done physical therapy and you've done other treatments and this and that, and the doctor submits all of that and says, look, the patient's done this, 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 and this, yes, a CAT scan could be warranted right off the bat.
Okay, so that follows up what you said initially, but didn't quite process it, which is everything goes to the insurance first and then comes back to you for payment out of the HSA.
Right, for MRIs, CAT scans, those types of things. Not everything goes
Okay.
to
So
insurance first.
I do not control my own destiny.
Not on some things. That is correct. Your doctor's office, and again, they know these protocols, and it's with every insurance company, the radiology protocols. They all have to be submitted first before the service is done.
Okay.
But you could still do that, you're just responsible for the full cost.
Absolutely, yeah. You can do anything you want to, absolutely, but
It
it
just
may
wouldn't
not
apply to
fall
the
under the
deductible.
insurance.
Gotcha. Would you get the, follow up on that question, would you get the reduced rate, the contracted rate? So I say, okay, I'm not going to submit it. Okay, so it's just out of your plan. Not gonna-
Yeah, it would be a denied service if you went ahead and maybe did that CAT scan or MRI. It would be a denied service for no authorization, and then, yes, the charges would come to you then. And in that case, the doctor's office would probably discount that rate.
Any other questions?
Today. Well, that's why the government put in that stipulation that anybody over the age 55 could do that additional $1,000, that catch-up contribution, so that, you know, people who are 55 or older can grow that money a little more quickly than 55 and younger can. So that's why they put that in there. Anything else? And if you guys, if you have a more private question, I'll be here afterwards too. I know everybody doesn't want to shout everything out in front of everybody. Exactly. For 2 years.
Okay, thank you all for coming. If you guys have questions later, you know, let me know. I can get with Tanya and get answers for you later too. So, thank you.